Hello everybody, welcome back to my channel. This is your girl Shiba. So recently I have been seeing a lot of articles like stocks to buy when the market crashes, or how to prepare when the market crashes, or what to do when the market crashes, or the banking system is collapsing, or the housing market is collapsing. In today's video, I will be answering possibly reasons why people think that these things may be happening, and hopefully better explain to them to you. And yeah, without much further ado, let's go ahead and get right into today's video. Before I go ahead and start talking about the possible reasons why I think a market correction will be coming, this is not a video about me telling you that the market is coming. I am not trying to predict the future. I'm just saying that these are some telling things to pay attention to that may suggest a market correction. I am not a financial advisor. I am not trying to tell you what to do, so don't forget, always do your due diligence. Now that this disclaimer is out of the way, let's go ahead and get right into today's video. So the first point I have for you guys is the housing market. Now, I am not into real estate, so I don't personally understand this very much, but there are some key things that I actually caught my attention. We are heading into the second or third straight month of us recording lower number of sales of housing, despite the fact that prices are still high. Now you may say, well, you know, it's supply and demand. That's supply is low, demand is high, therefore price is high. Now that may not necessarily be the case, because despite the fact that housing sale of housing is currently low and prices are still high, we may be going into the end of the CARES Act, which actually prevented for foreclosure on some people on their houses. And so coming to the end of that, that means that banks will now have the ability to step in and take the houses of those that have not been able to meet up with their mortgage agreements. Now, although these people may have had the opportunity to sell, and they're probably going to like a lower option for themselves, I don't know if they've decided to do that, but this is actually important, because if forbearance comes into play, then we may potentially find ourselves back into something similar to what happened in 2008. I am not an expert on this whatsoever, but I'm just trying to make you understand that forbearance is coming for a lot of people, and we might want to watch out for that, especially when it comes to the stock market. Now, another thing to take a look at or to understand when it comes to the housing market is interest rate. And I think the reason why interest rate is important in regards to this is because we are buying houses, and a lot of people have been buying houses because of the low interest rate. And why interest rate is important is because we have two school of thoughts, two pundits I call them, that currently have a disagreement. There is the Secretary of Treasury that says that there is a need to increase the interest rate, whereas the chairman of the Federal Reserve reassures us speech after speech that there is not going to be an increase in the interest rate. Now, these two experts definitely have their reasons as to why they say what they're saying and stand by what they're standing. And so the fact that they are disagreeing leaves investors in the gray area, and most investors usually like to play safe. And so because of that, if anything happens to tip the scale in a little bit, I personally think that a lot of investors are going to leave the market and probably go and hide behind safer investments like bonds and things like that. Now, like I said, I'm not an expert when it comes to the real estate and things like that, but I would say you can go ahead and watch more videos to better prepare or better understand what exactly is going on in the housing market. Now, the next point I have for you guys is the banking system. Now, for this one, again, I'm not an expert, but I gotta say something is definitely happening. Why I say that is because earlier in the year we had big banks. So there are four big banks of America. So there's Bank of America, there's Wells Fargo, there's JP Morgan, and there's Citigroup. And so earlier in the summer we had Wells Fargo that decided to end credit line for personal credit line, and a lot of people were revolted about it. And later, by end or mid-August, they decided to retract that statement and decided, okay, we are not going to end personal credit, but we are going to make some changes. Now on top of it all, to top it off, Bank of America, I think last month, liquidated a lot of its assets. And not just in America. In London, the Tesco Bank in London closed 213,000 of its accounts. To me, this is telling, because it's like the banks are definitely reacting to something. There is something that they're definitely preparing for. Something is definitely happening, and we cannot ignore that. And that's why I'm pointing that out on today's video. I don't know if this is telling to you or not, but let me know down in the comment section. To me, that was worth noting and mentioning. Now let's move on to the next point. The next thing I have for you guys is a high margin debt. We are currently riding a very, very high margin debt. And what is margin? Margin is pretty much the ability to buy on credit. If you have accounts like TD, Ameritrade, or Fidelity, you have the opportunity to open margin accounts, which means that you are able to borrow some money, buy stocks with that money, and pay interest back on the money that was borrowed. Now, usually you will be doing well if you buy stocks with the money that you borrowed and you are doing a lot of profit. That means that you haven't spent any of your money and you have made some money out of it. Why I think the margin debt right now is important for us to look at is because when we compare the margin debts in the past of 2008 and 2002, we see that the S&P 500 and the margin have been going together hand in hand. And I'm going to put a graph of it right up here. And back in 2008, as well as in 2002 or 2000, I believe, the margin debt spiked along with the S&P 500 just before the crash. And right now we are hitting all-time high numbers, wherein the margin debt is currently very high. And I know it dipped recently, and I believe that dip is probably due to the fact that a lot of investors are of the same sentiment that there is a crash coming soon, and so they are very much reticent about using margin and buying on margin. Again, on the flip side of it, we are still riding a very high S&P 500, and so these two correlations cannot be ignored. When we're looking at the crash of 2008, we see that there was a very big spike before it happened, and then the margin dropped at the same time when the market crashed. The next point I have for you guys is stock valuations. Now, stock valuations are determined by P/E ratio, and what the P/E ratio is, the price per earning ratio. This is pretty much a good tool to determine the health of a company in terms of like comparing the company's earnings, its profitability, to its current stock price. Should it reflect the price it's currently reflecting? Is it as profitable as it looks on the stock market? Should the stock price be as high as it is right now, or is the high price a reflection of its profitability? When we look at the Shiller P/E ratio, which is a good indicator that a lot of investors have used in the past when it comes to analyzing past market crashes, we see that the P/E ratio for the S&P 500 is actually very high. And I'm going to put a graph of it right up here, and we see that when looking at the Shiller P/E ratio, which is an adjusted P/E ratio to our present value of money right now, we see that before every crash there was a huge spike in the Shiller P/E ratio as reflected, and we see that in the 2008 crash, we see that in the 2002 market crash. And so for every market crash or every market correction that happened, there was a big spike in the Shiller P/E ratio. And on August 16, the Shiller P/E ratio was 38.91 to be exact, which is actually a very high number, because usually a good P/E ratio ranges between 25 to 30 and usually stays below 30 for more conservative investors. A P/E ratio above 30 indicates overvaluation of a company. And so a lot of investors believe that a lot of stocks right now are overvalued, and so their price right now do not reflect a true indication of what the company is worth. Another good metric to look at is the standard deviation of the P/E ratio of the S&P 500. JP Morgan did a study, and I'm going to put a graph of it right up here, that showed that we are currently at 1.6 times higher than the standard deviation of what the S&P 500 P/E ratio should be. What that means is that The S&P 500 right now is way overvalued, and we are riding very high numbers, and we should not be in that zone right now. And some correction is going to come into play at some point. Now, the last thing I'd like to mention to you guys is inflation. Inflation is pretty much a decrease in the purchasing power due to this rapid increase of prices. And we are currently facing inflation. And you may not see it, but trust me, that Tyson chicken at Walmart is definitely not what it used to be 2 years ago or back in 2019. Our current interest rate is around 5.86%, which is roughly about the same interest rate as back in the crash of 2008. And I would say it might be a good thing for you to go back and get a quick recap as to what exactly was the economic health of the country at the time when the market crashed in 2008. That will probably give you a better insight as to why we are comparing things from 2008 to now in 2021. Usually, inflation is brought about due to increase in interest rate, but we are not living in a high interest rate world right now, at least not yet. However, we are currently facing a high interest rate, a high inflation, I'm sorry. And so, again, the interest rate thing comes down again to the fact that we have two schools of thoughts that seem to disagree as to what the interest rate should be right now. That leaves investor in a gray area. Now, on top of that, we're currently riding high inflation, high margin, and high many other things. One thing that I would like to also mention is that Palantir recently bought $50 million worth of physical gold. I'm not talking about $50 million worth of shares of a gold stock or shares of a gold ETF whatsoever. No, I'm talking about physical gold bars is what I mean exactly. And so a company like Palantir that runs itself mostly on its cash reserves is using that cash reserve to back itself on physical gold. Know that something is definitely up. And on top of that, another thing, this may be unrelated to some people, but 90% of Palantir's customers is the government. I'm talking about the CIA, the FBI, NSA, Homeland, you name it. And if an information company like that, whose main customer is the US government, is backing itself or backing its company on physical gold, that means they know that something is definitely coming. And you cannot ignore that, my friend. You watching. Another thing to mention is, I think is worth mentioning, is AMC. Now, a lot of people, if you may not have heard of AMC, you just need to type those 3 magical letter words on your YouTube page and we'll see thousands and thousands of videos on AMC. And if you would like me to do a video on explaining what exactly is going on in AMC in simpler terms, because I had a hard time understanding it myself in the beginning, let me know in the comment section down below. And also, before I forget, please give this video a thumbs up and please subscribe to my channel. This is a means of encouragement for me and I will really appreciate it. Now, coming back to what is currently going on in AMC, I personally believe that its current price right now is definitely not a reflection of the company's value at all. It is definitely way overvalued. But the reason why it has been getting a lot of attention is because it's not because it's a meme stock, but also because of the SEC ruling that is going to be coming into effect, I believe sometime in September 15th or 9th. I could be wrong. Now, that rule coming into effect is definitely going to be a game changer for some banks and hedge funds. And why I think it's going to be a game changer is because it's going to put these entities or organizations into a difficult spot. And probably, in a way, I think, be one of the catalysts to the stock market crash. I could be wrong about this, but I think that maybe what the SEC is going to do in order to stop the shorting of AMC may force some hedge funds to go out of business and possibly start the snowball effect of the market crash. I could be wrong. But then again, let me know what you think down in the comment section down below. Like I said, if you guys want me to do a video explaining in simpler terms what exactly is going on in AMC, let me know. And Thank you guys for watching. I really appreciate it. I hope you enjoyed today's video, and I hope I was able to explain to you what is the current market condition in simpler terms, and also present to you with some compelling facts. Remember, don't forget to tell a friend to tell a friend. Let's all grow and make gains together.